Good morning, everyone. Welcome to Coffee with Carlson. Sorry for the delay in the start this morning. Oh, let me stop that music. Sorry for the delay in the start this morning. You notice I don't have headphones on. My wife told me, why are you wearing those headphones all the time? Well, I like to hear the startup music, and it sounds cool, but apparently it takes away from this, so I'm not wearing it today. You can see I went all out on my hair. It's kind of a cool, rainy morning this morning. Sorry, I had to take the son to school, and then I had to meet some people at the house. There was a lot of things going on. So, sorry for that. Today, I want to continue while I'm having my strangely warmed coffee. I think I've missed that plug the last few weeks, but if you want a great cup of coffee, this is it. Gives you a warm feeling inside. So today I want to continue year-end planning. I'll tell you, last week's topic was on cybersecurity. I could talk about that pretty much every week in the stories that come up. Just this past week, several news stories that popped up locally affecting local people or friends. So something really to think about. And maybe I'll cover another topic on that in a week or two. Or maybe I'll do a midweek show on that. Today, I want to talk about year-end planning. Year-end planning related to capital gains, capital losses, and how you handle your investments as we get closer to the year end. As most of you know, if you're invested in the market, a good strategy is between you. I want to be very clear here. A good strategy, I'm not an investment advisor, I'm an accountant. The strategy of your investing should be between you, your investment advisor, your financial advisor. Always talk with them, always come through the strategy. I think working together, especially if you're thinking about year-end planning, working with us is a great idea. We have great relationships with them. I have a meeting in a couple of days with a broker for one of my customers to talk about these very topics, and that's why I came up with the show today. In general strategy, as I've talked about with equipment, I don't recommend you buying or selling anything for tax purposes. Generally, if you're going to buy an investment and you think it's a good investment, then my opinion generally is to keep that investment. Don't sell it because I'm going to get a gain or a loss. But there are some exceptions to that, and there are a few caveats to think about. So as you go into year end, you really need to talk to your investment advisor, then sit with your accountant and do some what ifs. Tax planning is very important because I've seen cases where $1,000 in income that you didn't think about throws you into another limit, a tax bracket, and that can trigger higher tax rates even on capital gains. A lot of people think that capital gains are a flat rate, but they're really not. They are based off bracket system as well. So you want to really plan for that, sit down with them and talk about it. There's two things that are important and that are relevant and came up in the past week with my customers. The first one I want to talk about is capital gain or loss harvesting is kind of the terminology that people use when they're referring to what we're doing now, year-end planning related to investments. Investments are up right now for the most part. So you can see the stock market's going up, your individual investments are probably going up, your 401k is probably going up. And it's another side note, none of this really has any impact on a qualified retirement plan because there's no capital gain or losses realized inside there. So this is only your taxable after-tax investment accounts. Hi, and good morning to everyone that's watching so far. I really appreciate you being here. The first one I want to talk about is wash sale. This is if you're thinking about trying to harvest some losses, capital losses, in order to offset some gains or some capital gain distributions through your mutual funds. So if you're going to hold an investment anyway, meaning you don't want to liquidate it from your portfolio long term, then this is something very important to think about. If you buy or sell, if you buy or sell, say scenario, if you sell a stock right now at a loss to capture those losses, but then you want to simultaneously buy that stock back, you're going to trigger what's called a wash sale. A wash sale is when you can't realize the losses that you just tried to take advantage of. And what triggers a wash sale is buying or selling the same security within 30 days before or after the trade that captured the losses. So for instance, sorry, Alice is here. She wants to say good morning. Come up here. Come here. Say good morning. Oh, I'll get her. Say hi, Alice. Hi, Dad. Okay. So wash sale, if you buy or sell within 30 days before or after, before is the important part, or after the date that you realize the losses, then those are going to be disallowed and you won't get to take them to offset any gains you have. So it's a very important timing thing, and it could trigger it could cause you to, there's a lot of volatility, could be a lot of volatility within 30 days, especially toward year end, especially with the political environment that we're dealing with right now and recounts and what's going to happen in January. So something to be thoughtful of as you're looking at losses to harvest, that you might trigger wash sales, something to think about and talk with your broker about to make sure that you don't lose them. And just about every client I have, when I get their brokerage statement at the end of the year, there are adjustments for wash sales. So you may think that you're harvesting some losses, but you're really not. I'm trying to see if I can square my face with the camera, because sometimes it looks like I'm looking to the left, and probably because I'm looking at the screen that I'm on just there. Anyway, okay, so wash sales, something to talk to your broker about if you're thinking about harvesting some losses. Very important, could cause you to lose those. The second thing is capital gain harvesting. Capital gain harvesting might sound strange, but what you're doing in that strategy is taking advantage of a year when your other income could be low enough to capture a 0 or 15% capital gains tax rate and pay the lower taxes and then buy it back simultaneously. Wash sales are only related to losses, not gains. So you could theoretically sell $10,000 worth of a stock today at a $5,000 gain. And what you're doing is resetting your basis from $5,000. If you originally paid $5,000, today you sold it for $10,000. You'd reset your basis at $10,000 and pay the tax on the $5,000 gain that you're realizing in this year. And when you might want to do that is when your other income is lower. For instance, this year, you're not required to take your annual required minimum distribution from qualified retirement plans. So if your required minimum distribution is $25,000 and your taxable Social Security income is $25,000, you don't take the retirement distribution, then your overall income would be low enough to trigger a 0% capital gains rate. Again, this is something very important to sit down with your broker first to find out what your unrealized gains are and which ones you might be able to capture to step your basis up, especially if you think they're growth stocks that are going to increase in value over time. A strategy to determine with your investment advisor, and then you're going to reset your basis at a higher amount. So later on down the road, when you need to sell those, when you're going to sell them to liquidate that part of your portfolio, your basis is higher, you would pay lower capital gains tax rate on the other. Again, these strategies can be combined. They have to be looked at closely. You really need to contact your tax preparer and have them do some what-if planning for you to determine if they're the best, if it's the best strategy for you. If your income's really high and you're not going to worry, you can't get it lower, then it really not a strategy that matters to you. If you're already over the limit to get you into the 15% tax rate, the difference between 15% capital gains rate and 20% capital 20% capital gains rate is from $40,000 to $440,000. So if you're somewhere in the $40,000 to $440,000 range, you don't need to really worry about this harvesting of capital gains because you're going to pay the higher rate anyway. You don't necessarily want to hedge whether or not the rates will be higher or lower next year. It's impossible to plan for that because you have no idea what's going to happen in the political environment. So not really a need to pay attention to that. So don't worry about it if you're in that category. Most of this would happen to those people that are right around the $40,000 mark for income in their capital gains tax brackets and can plan for that. Mostly would hit the retired community that are getting Social Security and they have investment income, interest, dividends, capital gains. So they might be able to adjust this a little bit or pay attention to it a little bit as their income could fluctuate from year to year depending on the value of their retirement accounts, which sets your required minimum distributions and a few other variables. But the variables are so much that it's worth a call. It's worth a call to your tax preparer or an email. Hopefully that's Carlson Accounting. We would love to have you. And have them do what ifs, run the real scenarios, see what it's actually going to cost you, because a small change in your income could have a big impact on your tax from 0 to 15%. That's a pretty big jump. And that's pretty much it for the income harvesting of income tax and capital gains harvesting or loss harvesting. So most important message here is if it's something you think you might be able to take advantage of, meet with your investment advisor, also meet with your tax preparer to contact them. I hope you had a great morning. If you need to reach us, you can go straight to our website, carlsonaccounting.com, or right here on Facebook. If you go to Carlson Accounting, you can click on there and make an appointment. We're still doing in-person meetings. We can do phone conferences. We can also do video conferencing. Whatever is most convenient for you, we can handle all of that. If you wanted to do a video conference with us, you and your broker, you can come here and we can do that and pull your broker into the meeting. Maybe they're up north still, or we can do it from your house, me and your broker, wherever they're located, if they're in Sebring or somewhere else. So carlsonaccounting.com, you can learn more about us and schedule an appointment, or give us a call anytime at 863-382-4141. I'm going to go make another fantastic cup of strangely warm coffee and get to work on my day. Thank you very much for joining me on Coffee with Carlson, and God bless.